Earl to present to us. He's very much in that whole economic and particularly money market interest rate type environment. A little bit different from Earl. You may or may not be aware we had Brad Olson present to us this morning, obviously on general, macroeconomics. Earl obviously has got much more of a money market slant. So look, really looking forward to hearing from you, councillors, because our screens are not working. I think Zoe is looking to push Earl's slides out on Diligent. So in the next couple of minutes they'll be on Diligent. But look, in the meantime, Earl, feel free to get underway taking us through your presentation.
Okay, thanks very much, everybody, and apologies I can't be there, but I'm unfortunately in Hua Hin in Thailand. So I think Waipa and the Waipa District Council and Te Awamutu in the winter, lovely place, but Hua Hin at 32 degrees is a bit better. Okay, now if you have unfortunately, as I said, there's a problem with my camera, so I can't share the screen. So I'll just go through my presentation, and first of all, slide 2. If you haven't got it in front of you yet, I'll just talk through it, and just if you could let me know when everybody's got the slides, and I can go through. So the first slide really is, as Treasury advisors, and focusing on, as Ken said, your interest rate risk, your borrowing profile, Treasury policy, those kind of things. What things keep us awake at night? And there's some overlap with Brad, of course, but we try and drill down these economic factors into how they're going to affect, especially interest rate level and currency levels. So the major concern for us at the moment is really the Chinese economy. Our export sector, we all know that we've got a pretty strong reliance on Chinese demand. And that not only includes dairy and our other exports of that, it could also, as a very tourism and education, Chinese participants in those two sectors are a very important part of those, education especially. And tourism, put in perspective, China was probably close to 500,000 tourists a year pre-COVID, and we haven't got anywhere near a recovery to that yet. But so China's pretty important. And the issues the Chinese economies are facing is that everybody thought there was going to be this big bounce back after they came out of COVID lockdowns. And, everybody's anticipating strong demand and everything back on track. Now, what they did do at the very start was they've got a major issue in their housing sector, and they did do a lot of stimulus to try and sort of get unfinished apartments, and a lot of their development companies were under huge stress. So they bailed them out to get things finished. And that sort of, we were seeing rioting in the streets in China around people who had mortgages but didn't have buildings finished. So that was quite significant. So they managed to sort that out. And that was late last year, early this year. We saw quite some strong stimulus from that. But since then, it's really started to slow down because their property market is under pressure, house prices are under pressure, and urban youth unemployment in China, that's 16 to 24 years, is new high of 21.3% in June. So more than 1 in 5 young people in China are unemployed. So that's a pretty scary stat. And that's flowing through to a lot of their numbers. Latest retail sales were weak. And China's projecting a 5% growth target for 2023. And that was sort of looked on as pretty conservative, because you've got to remember that, previously China's been growing by 10, 12, 15, 20% per annum. And 5% is probably just ticking over, quite frankly, or almost recessionary. Now that's starting to look not so conservative now, and there's a few issues around that. So the dairy sector's been seeing some problems. Most people, well, a lot of analysts were expecting the payout this current season, 23-24, and that's probably close to the heart to a lot of your ratepayers. At first was expecting $10, and now we're seeing a payout, with a 7 on the front, and some people are expecting, low 7s. Compared to this season's probably around 8.20, 8.25. So this weakness in China is having a direct impact on demand, and more importantly, prices for our producible exports. So China's our major concern, because that's a major influence on our economy, and our domestic economy is weak anyway. So having our major trading partner weak as well is obviously not a good look. Europe is starting to fall back. European central banks have been hiking interest rates and to try and get inflation under control, like everybody has. So that's okay. But the latest growth data out of Germany and France, the two big economies there, was worse than expected. So Europe's got a bit of an issue. And while Ukraine's off the front page, we see the recent moves on grain exports show how quickly, things can turn. And, clearly the spike in commodity prices when Russia invaded Ukraine had a major inflationary impact. And we are starting to see grain prices start to sneak up a little bit again. Now, the good news is that the US economy is still looking really solid. The Federal Reserve has put interest rates up to 5.25 to 5.5%, their cash rate target, which is basically in line with ours. But it does look as though the Fed's going to engineer a soft landing. Growth in the US is still solid. US equity markets are very strong. The housing market's looking okay. Consumer spending's holding up with wages. And, while they have had a massive increase in interest rates like here, we definitely are seeing some, it's still looking good. And that's really good news for us and good news for the global economy, quite frankly. The little concern out the back end is the US presidential circus kicks off later this year. And unfortunately, during these presidential cycles, you tend to see the US become even more inward looking. And they tend to make sort of some weird decisions every now and again, driven completely by politics. So that's going to be, we're going to have the Republicans versus the Democrats. And, we're not sure how that'll pan out with regard to their foreign policy and trade policies and all those kind of things. But, that is going to be a potential issue down the track. So those are the main things that we're sort of worried about at the moment. I haven't mentioned the domestic economy because, it's doing what the Reserve Bank probably thought it wanted it to do, slow down. And at this stage, it's not looking too much worse than what we expected it to be. So while it's always a concern when we're in recession or the economy's slowing, we understand why that's happening. So if we go to slide 2, what are our clients?
Sorry, Earl, I'm just going to stop you there for a second. So councillors, we've just put that presentation in the main body on page 187 of your agenda. So we couldn't see your presentation up until now, Earl, but we're now able to do that. So just letting councillors know to refresh their diligent, and you'll be able to see Earl's presentation.
Oh, great. So I was just going through page 2. There's just some bullet points there I've been talking to. So there was nothing much to see there. Now on slide 3, if you can go to that, what are our clients? And our clients are from councils to major exporters such as Zespri, huge importers like the fertilizer guys, major dairy companies, meat companies, manufacturing, education, professional. So right across the private and public sectors. So, and it's interesting. So when we meet with clients, we ask them to tell them what's worrying you at the moment, because there's no point in us telling them what's worrying us if none of our worries are actually worrying them, because then we're not actually doing our job, because our job is to give a tailored service to our clients, not dictate to them what we think their concern should be. And interestingly, the big concern is ESG. So that's climate change, socially responsible investing, all those kind of things. And I think, the headlines in the papers in Europe with, forest fires and people abandoning resorts in Greece and all that kind of stuff, and the heat waves we're seeing in Europe and the weird weather we're seeing in the Southern Hemisphere, those environmental concerns and those socially responsible investment concerns, and just having a general socially responsible framework is really coming top of the agenda for a lot of organisations. And that's been driven by, I suppose, external pressure to actually address those issues. Another big issue is facing is data integrity. We've had a lot of publicity recently about cyber attacks and hacks and all those kind of things. And some very, very large organisations in Australia have had their databases hacked and a lot of personal information, released. So that's definitely so. So those are the two issues. It's interesting that market volatility and all those kind of things, sales, election risk, wage inflation, they're all falling down. And in the last 6 months, we've seen staff shortages was consistently top of the concerns for clients is now basically one of, it's just making the top 10. So we have seen a big turnaround. There's two reasons there. One is there's been a lot more immigration and people coming to fill slots. And also a lot of businesses are much more conservative now because they're worried about the outlook. So they're either not hiring or they're actually laying off staff. At this stage, it's more just trying to look after the staff they got and not expanding. But yeah, it's interesting how that's switched quite dramatically. And, I suspect the council had some real issues around staff shortages and all those kind of things not that long ago. But yeah, so that's what our client base is telling us that they're concerned about. So, it's interesting that recession's not even there. I mean, receivables and sales and those kind of things are clearly, reflecting that. But, it's these other esoteric issues that are sort of not esoteric, but these sort of longer term issues that seem to be dominating at the moment. And maybe that's just a sign of, what people are focusing on currently. And by the way, if you've got any questions we're going through, maybe just, either ask them as you're going through or at the end, whatever suits you guys. Okay, let's go to quickly slide 4, sorry. So what that shows is, looks as though inflation's peaked, doesn't it? So we had all those lines of various countries. We saw UK inflation sort of peak around 11%. We had US inflation sort of up around 10. New Zealand's inflation we didn't get quite that high, but we're coming down a bit slower, maybe because we were, one of the lower peaks. But there's definitely so global prices are falling. A lot of those supply chain issues and the high shipping costs are starting to work back through the system, and they're back to normal or even lower. Interestingly, China's inflation is 0. So that just highlights, the challenges their economy has. So, you talk to some people in China and they say that, inflation doesn't seem to be to 0 to them, but it does show that, they didn't have that boom and bust, so that low inflation there is actually a bit of a concern. It's not a positive at this stage because it shows how fundamentally weak their economy is. But we do look as though we've seen peak inflation, which is good news. The cash rate projections for New Zealand, Australia, and the US. So the first one is where the cash rate is currently. So it's 5.5 in New Zealand. In the US, the mid rate it's 5.25 to 5.5, so a mid rate of 5.375. In Australia, it's 4.1%. And as you can see, market pricing. Now, this is market pricing. This is not economist projections. This is not me putting my finger in the air and going which way the wind's blowing. This is the forward pricing. So while it's a reasonable indicator of direction, it's certainly not a good indicator of where they'll actually be in 18 months, but you can trade this. So if people were really strongly against these views, they could actually trade this and the market might move. But what this is showing is that in general terms, the financial markets think that cash rates have peaked and they will slowly decline. So, we're not the US markets are still expecting the Fed to start cutting sort of early next year and cut quite aggressively. We think they're a bit optimistic with that. But here in New Zealand, the market's really not expecting the Reserve Bank to think about cutting interest rates the middle of the next year. And we would agree with that. Now, the speed of their cuts depends on whether we have a mild recession or whether things get worse, and that will depend on some of our export sort of situations. But yeah, so basically what we're really saying is financial markets are agreeing that yes, the peak inflation has been seen, but it's going to take high interest rates a while to get inflation back to their targets. Now, it's easy is not probably the right word. Getting inflation from 12% to 6% is a lot easier than getting it from 6% to 3%. And, targets are 2 to 3%. So our general view is that the cash rate's going to stay elevated well into next year, and then will slowly come down. Now, term rates will fall a bit quicker because they anticipate cuts in rates. But at this stage, higher for longer is our sort of view of the cash rate. And again, we look at the US 10-year bond rate. So that's been trading between 3.2 and 4-ish over the last nearly the last year. And it's back towards the top of that range. And while the markets are comfortable that inflation is under control and we've seen the peak, or at least they've seen the peak, concerns of, the strength of the US economy means that these term rates are staying up. But 4% historically, while it's a high rate, it's not an exceptionally high rate. We just got used to zero rates during COVID and sort of forgot about normal interest rates and normal interest rate cycles and things. But yeah, the US bond rate, the longer rate is saying, yeah, we also believe that, inflation will be a little bit sticky, so that they'll have to leave cash rates high for a while yet. Here in New Zealand, our 10-year rate is trading sort of between 4-ish and 5-ish in the middle of the range. So what you've got here, we're following offshore moves as they go up, but it's recession versus inflation. So we're in the middle. We're going, we think that rates will stay higher for longer, but we're a bit worried about the recession. So if we get a worse recessionary outcome than what we're expecting, the Reserve Bank might have to do something dramatic. And so that's why those rates are sort of in the middle of the range, but broadly following US moves. And there's the graph. So New Zealand in recession, December quarter negative growth, March quarter negative growth. The jury's out whether the June quarter will be negative. The Reserve Bank was projecting June and September quarters to be negative. Whether they're negative or not probably doesn't matter. They're going to be flat basically at best. So we're going to have 4 quarters or 12 months of negative growth, and that could be around 1% or maybe hopefully around 1% max, minus 1% for the 12 months from September, from 1 October 22 to 30 September 23, and then maybe we start to see a little bit of growth again. But definitely, we're seeing a much weaker domestic economy, but nowhere near as bad as the collapse we had during COVID, of course. But that was then the big bounce back. So, but growth is definitely, is very, very weak. And consumer confidence is still pretty low. So as you can see, there's the ANZ Roy Morgan Consumer Confidence. It was down slightly in July. But the big thing is that it's whether it's a good time to buy a major household item fell from minus 27% to minus 39%. So the vast majority of people think it's not a good time to buy major household items because their household budgets are being, squeezed by higher prices and all those horrible higher fuel prices, higher mortgage prices, higher everything. And so their discretionary income's falling. So, that doesn't bode well for retail, especially big ticket. But as you can see, consumer confidence is bounced off the all-time lows, but it's still gyrating around those all-time lows. So your ratepayers and consumers are expecting things to be pretty tough for, the next year or so at least. And, we're clearly seeing the impact of higher interest rates on the economy, higher, arrears are growing right across all the lending things. Centrix, their latest data had, nearly 12% of the credit market was in arrears in May. Business liquidations are increasing. Business liquidations can be a good thing or a bad thing. New Zealand's a lot of small businesses. Businesses are created, businesses fall over, new ones come along. So that's not necessarily economically destructive. But when you're having liquidations increasing and new business formation falling, that's not so great. And that's probably what we're seeing now. But as you can see, higher interest rates are having the impact that the Reserve Bank wanted, really. The Reserve Bank wants people to stop spending and not borrowing so much, so it takes the pressure off prices. So if we go to slide 11, that sort of shows we haven't actually, the impact of mortgage rates on your ratepayers and consumers hasn't peaked yet. Now, Westpac project that it'll peak just above 6%, and that will be sort of early next year. So there's still more pain to come. So, we've got another 1 to 1.5% of higher mortgage payments to flow through the system. So there's a lot of cash to be taken out of borrowers' pockets still. So that's why consumer confidence is relatively low, because consumers are starting to, we're starting to see, a lot of people now are starting to see these fixed rate mortgages at low rates run off, and they're starting to refix. And that pain is going to be around for a while yet and get worse. So that's why it's very hard to make up a picture where the New Zealand domestic economy is going to bounce back strongly anytime soon. In fact, it's going to remain, as we say, probably recessionary. But the Reserve Bank isn't going to cut interest rates just because of that. It's said it had to have a recession to get inflation under control. So, at this stage, these kind of numbers and these kind of stats aren't a big flashing red light that interest rates are falling anytime soon. Now, if the economy falls into a huge hole and a lot worse than what we're expecting, obviously that will change the whole dynamic. But at this stage, it does look as though it's tracking down to that modest recession the Reserve Bank expected. And the reason why higher mortgage rates are having so much of an impact is we've got a lot more debt. So bank household debt, since the global financial crisis in 2007, which was nearly 20 years ago now, that's scary, isn't it? But, so since then, household debt's increased by 211 billion, and 68 billion of that was after COVID. So 211 billion of more debt. So let's say interest rates are 5%. So that's 2 times 5 is 10. So that's $10 billion a year of more of interest expense just on the new debt than there was back in the GFC when things were quite tough. So as you can see, households, they all everybody feels wealthier because the house price has gone up, but guess what? Most of it's been funded by borrowing. So all we've done is we borrow more to pay higher prices, and then we have higher interest expense. I think I've said to you guys many times that I don't see this as a long-term way to prosperity, to sell more expensive houses and farms and goodness knows what's to each other. We need to be more productive and selling more in the world at higher prices. But that's another argument, and I'm probably too late for me to try and change the world with that, and I probably couldn't anyway. But as you can see, that's why households are under pressure. Interest rates are higher, and there's much more debt. And as you can see, in an economy that agriculture is still a hugely important part of our export sector, and despite what some government ministers and some people down in Wellington say, agriculture, really is a major part of this economy. It's only 11% of debt. 65% is mortgage debt. Maybe if we had 30% of agricultural debt and farms were expanding, we had more production, more productivity, higher value add, rah-de-rah-de-rah, who knows how things could be. But, New Zealand debt is dominated by the housing sector, and that's mortgage debt on houses, because we've got some of the most expensive houses in the world still, and we haven't got the highest wages in the world, that's for sure. Okay, look at just practical terms, Te Awamutu and Waipa, it's dairy country. I see a few kiwi fruits coming down now. Maybe global warming, it'll change. But, so the dairy price has fallen quite a bit. It spiked up during COVID, and that was really around supply chain issues. China ran their stocks up dramatically, like they were running stocks 50 or 60% higher than normal, and they've still got higher stocks than normal. And this is one reason why why prices are suppressed. But the GDT index, which is an index of overall dairy prices, is back down sort of, where it traded for, about 2 or 3 years pre-COVID. So unfortunately, that looks sort of average. That's okay. We've had a boom. We've got back to normal. We haven't fallen to the lows we saw in 2015 when the payout was $3. So on the face of it, that looks okay. But the problem is on-farm prices have gone up. So, so a $7 payout certainly not as attractive as it used to be. And, and a lot of farmers need at least a $7 and probably an $8 payout to actually make any kind of return. So, the export sector is not actually coming to the rescue for the domestic pressures through higher mortgage prices, etc. at this stage. So that's why, the economy is going to be relatively weak for a while yet. But if we look at the, the dairy price, this is slide 14, we look at the dairy price compared to the New Zealand dollar. So the dairy index has fallen sharply this year from up around 400 down to sort of under 300. And the currency's fallen from 70 cents down towards sort of, been a bit lower, but it's around. So the weaker Kiwi does help. The Kiwi dollar's, below its 2-year average, and the dairy price is well below its 2-year average. So the weaker Kiwi is offsetting to some degree, but it's not enough to, to offset those falls in dairy prices and pull the payout back up towards 8 or 8.50. So it's more likely to be 7 or 7.50 or worse. But what it does show is, there's commentators out there saying the New Zealand dollar's weak. Well, based on our exports at the moment, the New Zealand dollar needs to be a little bit weak, quite frankly, to offset some of those other pressures in the economy and give us a bit of cash flow. Tourism to the rescue? Well, maybe. So as we can see, we had a December last year, nice spike, out of COVID, but still the December last year, the peaks were, still less than, we're going back sort of, 7-8 years. And so hopefully this year is looking quite good, but we're still going to be battling to get up to anywhere near pre-COVID levels for a while yet. And Chinese inbound is still relatively weak compared to what it was. And that was growing every year, 10 or 15%. So it's actually lower and it's actually not growing. So, that's quite an impact. So that's, so tourism's certainly looking better than it was, but combined with staff problems and, some tourism, you've got tourists coming and, places can't open 7 days a week because of staff shortages, and hotels can't open all their rooms because of staff shortages. Now that's slowly starting to improve, but so while tourism's going to be a positive, it's not enough to offset those weak commodity prices. And, and it's still not back to pre-COVID levels. Is migration the answer? Well, we've had a big spike in migration, not surprisingly, as we've opened up but there's, big backlogs of people that were in the system are being processed. But again, we're seeing signs now that that's starting to peter out, and departures are getting towards, they're well above pre-COVID levels and still climbing. And that's, in the press, we're always reading about somebody going to Australia for, higher pay, et cetera, et cetera, et cetera. So while immigration has been a positive, we are starting to lose our brightest and best again, which is a bit of an issue. And then, you read in the paper, you see these scams, so 1,000 applications for people to come and clean up in Hawke's Bay, and it's an immigration scam. And then you read in Australia, there's been lots of scams. So, there's a lot of immigration suppliers from offshore that, get people to come to New Zealand, for example, and, do their paperwork. There's a lot of dodgy stuff out there. So really, I think, if we can focus on quality immigrants, and, it's not necessarily the high numbers that's going to save us. It's, it's quality immigrants that fill the roles we need. But it is, it's definitely a lot better than it was, and that's, we're starting to see that in hospitality and tourism. Some of the young backpackers coming back and filling some roles again, and, it's easier to get sort of workers onto the farm sites and those kind of things. So that's a positive. So, but I think this in one slide shows the issue we face. So this is slide 17. So that shows the current accounts for Australia and the current accounts for New Zealand. So Australia is running a current account surplus of about 3% of GDP. So that's 30-40 billion. We're running a trade deficit. We've got a current account deficit of heading towards 10%. So Australia is earning more than it spends. Now, it hasn't for a long time, and it only just started back in 18, but with the mining boom and increases in gas prices and iron ore prices and stuff. But in general terms, the Australian economy is earning more than it spends. So Australia can spend more on infrastructure. It can give tax breaks. It can basically make it better for its citizens because it's got more money than it spends. New Zealand, we spend a hell of a lot more than we earn. So no matter who's in government, there's always pressure on what you can spend, what you can do, what infrastructure you can put in place, all those kind of things, because we're borrowing just to pay we're borrowing to put food on the table if we're a household. We're not borrowing to build a house or expand the factory. We're borrowing to keep the lights on. And, and that's one of the reasons why Australia is increasingly attractive, because they can afford, their public sector can afford to pay people more because they're, they've got money in the tin. So that's a stark graph. You look back historically, we've been very similar to Australia, but the gulf is, that's pretty ugly. And that's another consequence of that is, the massive amount of debt we did during COVID, which was, you can argue that there was too much, not enough, or whatever. But at the end of the day, the bills have to be paid, and the size of our economy, it's very important. So we need to be producing more at higher prices, selling more offshore. We need that gap to close, because if that continues, that's a real issue. And ultimately, it would mean that people will offshore investors who fund this will require higher interest rates for us to fund us, because they'll look on us as being more risky. Hasn't happened yet. Our AAA rating's not under threat, but there have been murmurings that New Zealand needs to get its house in order. So that's a pretty stark graph, quite frankly. Councils with carbon, as we know, politics gets involved in carbon pricing. So, the political situation was to get carbon pricing up to make it more expensive to pollute. That was the theory. And then basically, so the market decided, we'll just grow a whole lot of trees, we'll turn a whole lot of productive farmland into forests, we'll get the carbon price drops. So now they're actually looking at what they're going to do. And I think that's a good thing. They're actually looking to actually have carbon signals that incentivize you to actually not pollute in the first place, rather than have signals which mean I just can pollute as much as I like or just pay for it. And I think, I don't know, it seems to me conceptually, and my daughters, and they're the generation that are going to suffer a lot of this stuff by the looks of it. Their view is that it's better not to pollute than just pay for the right to pollute. So unfortunately, New Zealand's not going to make too much difference in the global scheme of things. But those recent review the government's doing seems to me to be quite a good thing. And that will mean that the carbon price dropped quite dramatically, but it should start to sneak up again. So that's it, really. So from a long-term plan point of view, we would expect that interest rates will remain around current levels probably for the next few years. So we don't see the cash rate dropping anytime soon. As I said, probably middle of next year. Longer term rates will, like for example, the 5-year base rates around sort of 4.7%. When you look to borrow off the LGFA with fees and all those kind of things, it's probably, there's a 5 on the front. Now that's high compared to historically, high compared to COVID, but in the big scheme of things, interest rates of 4 or 5% were normal in New Zealand. So if you've got inflation at 2.5%, you've got a return of a couple of percent. Interest rates around 4.5 to 5 shouldn't shock us. They shouldn't be exceptional, because we just got used to ridiculously cheap credit for a while, and look at the issues it's created. So sometimes what you wish for is not actually going to work out so well. So from a planning point of view, you could probably plan for borrowing costs. Those longer term costs will continue to sneak lower. And our view with Ken and the team has been that we keep our current borrowings relatively short, and then we look to, when we're looking to do that 5, 7, and 10-year borrowing as debt continues to climb, we'll look, the next 12, early next year and later, we should start to see those term rates fall. Better to borrow at high rates for a year and then get a lower rate in a year's time than borrow for 10 years at the absolute high. But there's maths we do to work out those kind of things and break evens. But in general terms, don't expect interest rates to be dramatically lower, definitely 23, 24, and possibly not 24, 25. And then we might see them normalise a bit. But we'd expect that the cash rate average over a 10-year LTP cycle, you'd expect that to be around sort of 3.5% average, maybe. So, we've got a inflation target of 2 to 3. So let's say inflation average is 2-ish. We get down towards those levels, you're going to have the cash rate sort of average above inflation. So, a cash rate average of 3.5 over the cycle would not be an unrealistic projection. And I suspect, so we're definitely not saying that, it's okay, cash rates going back to 0, guys, or going back to 1%. This is just an aberration. Those 0 interest rates were the aberration. From a borrowing point of view, Waipa very solid. LGFA did an Aussie dollar issue, an Australian issue last week or a week before, and was very well received. Still getting reasonable pricing. So the LGFA is managing to still get good pricing, which flows through to you guys. So that's all good. No issues around the volumes and funding and things. So that side's all very good. Three Waters, who knows? I mean, they're looking to set up another funding vehicle with the LGFA manage, but we've got an election in October. Who knows what's going to happen? So, really, there's no point in us sort of telling you, oh, Three Waters means you're going to lose debt, you're going to do that or the other, and this is going to happen because we've got as much idea as you. So that's a disappointing thing when you're trying to do your long-term plan, that there's a potentially major change to council land in New Zealand, that, you know, if there's a change in government, it could be overturned and come back some other way. There will be some sort of structure, but, you know, it's a bit of an unknown. So I can't really help you too much there, and I suspect Brad didn't probably have too many concrete things to say about that as well. But, you know, at this stage, it's going on as if it's happening, and, you know, we just have to assume that unless there's a change of government, it will happen. But, you know, the polls are telling us there's at least a 50-50 chance, so there's definitely uncertainty around that. Any specific questions or comments, or is that all good?
All right. Hey, look, thanks, Earl. We will open the floor for questions if that's okay, and we have a couple of minutes.
Sure.
Start with Mike.
Yeah, hi, Mike Pettit here, through the chair. Thanks for that presentation. My question is, with regard to long-term plan, and we heard it from Brad this morning too, about interest rates sort of staying pretty solid for the next sort of 18 months or year or so. Our long-term plan projects, our big stuff, what would your suggestions be around where they should sit in the LTP? I mean, is my gut feeling that the big ticket items we should be holding off because build costs look like they're going to drop, and interest rates look like they're going to drop. So why would you do them in the first couple of years of the LTP? Just your feedback on that, please.
Yeah, I think those are reasonable comments. You know, the expectation is that interest rates will drop lower over the next couple of years. So, but if you're doing a project that's going to be around for 20 years, you know, funding those things on a floating rate basis that are slightly more expensive for the first year or two, and then locking in those rates later, which we can do at lower rates. You know, you're not paying the high rate for the whole time of the project. So I think it comes down to, you know, you want to be ready to move. I think if you see these recessionary forces pushing pricing down, and you start to see contractors, etc., become quite competitive. So there might be a window of opportunity over the next few years where, you know, things are looking tough in the construction sector. There's no doubt about it. Things are looking tough in a lot of those sort of areas. So, and we are starting to hear, you know, and, you know, council projects and council spending is, you know, what you have to do is sometimes a bit different. But, you know, we're hearing sort of house quotes for new builds a year ago a third lower because there's so much pressure. So I'm not saying that, you know, you should just do things blindly, but it'd be quite good to have the ability to be a bit nimble. So if you do, because in 3 years' time, if things start to normalise, and hopefully they do, you know, we start to see the economy recover and things start to go back, then if everybody's doing what you're doing, you know, everybody's out there trying to get things done. So I think, you know, you want to be a little bit nimble, quite frankly. But yeah, you know, over the next 6 months, 12 months at least, we would expect pricing pressures to ease further and interest rates to drift. So I wouldn't be saying, you know, go and fire up the bulldozers and try and do everything in the next 6 months, that's for sure.
Who wants to go next? Gary?
Thanks. Gary Dyte here. Earl, another great presentation, so thank you. Looking at the Australia-New Zealand annual current account slide, we've been so close to Australia since the 1990s. What's caused that major divergence between Australia and New Zealand in terms of the balance of accounts?
Two things. As our debt levels have deteriorated quite dramatically, and the New Zealand banking system has to fund from offshore a lot of its borrowings to advance the housing market. So that causes a transfer issue. The main thing is that our exports as a percentage of the economy are actually relatively stable, whereas Australia's been growing. So their iron ore exports have grown quite dramatically, and then they've had a lot of their gas projects come on stream. Now, the corollary of that is, you know, you have this ridiculous situation that the east coast of Australia is short of gas because they're exporting it all. But But Australia's and those hard commodities have tended to do better than our agricultural commodities. And, and our problem is we've reached peak milk, I mean, anybody trying to expand, into dairy, expand their dairy, it's difficult now. The expense, also the environmental issues and, all those kind of things. So we're probably at peak dairy, our cow herd's probably coming back a little bit. So we physically can't produce much more milk. Our farmers can become still more efficient, and they can squeeze more milk out of each cow more efficiently, we are very efficient at that. Same as our other producers, and meat and, grapes and kiwi fruit and all those kind of things. But at the end of the day, it's hard to really expand those exports. Whereas in Australia, they just start to dig a bit more, stuff out of the ground and chuck some more iron ore on a boat, and they just pump some more gas. So their export situation has been more attractive than ours, and also our fundamental debt situation means we continually borrow more. So if you're borrowing more, paying more interest, it tends to exacerbate that current account issue.
Right. Ken.
Hey, hi, Earl. Ken here. Hey, look,
Hey,
just a couple of questions from me, which I'll do separately. Let you answer them in turn. Hey, so you talked about the Three Waters thing, and certainly appreciate the uncertainty in that environment at the moment. But this two entity thing interests me a bit. So so LGFA will be here in the longer term for council business, other than Three Waters. But of course, a huge amount of that LGFA loan book at the moment relates to Waters debts, and what you mentioned was they're looking to potentially create a new entity to accommodate that. But look, if a huge amount of debt book moves out of the LGFA into this other entity, look, are you seeing any risks there in terms of either liquidity, of availability of money through the LGFA, or the pricing of that money? Just interested in that.
Yeah, I think the way it's sort of talked about is that it'll be it'll transition as things mature, and from a pricing point of view, it won't be too bad. The problem I think is that the LGFA has joint and several council guarantees. So you're in there, and every council's got a piece of the pie, and piece of the exposure, and the ability to rate means that can be that helps drive that AAA credit rating. Whereas the water entities, I believe there's issues around trying to get the entity getting access to the cash flows if somebody defaulted or whatever. So it's much more problematical. So and interestingly, when our discussions with a lot of the Three Water guys was they really didn't think about the funding structure until later in the piece. Whereas I would have thought it would have been the first thing you got, and you would have sorted that out first and then sorted everything out later. It was sort of like as an afterthought, and we're talking, it's rather a big afterthought, billions of dollars. So I think that the funding of Three Waters and how it's going to work, the issue that it could face is that there's only a certain amount of capacity globally for New Zealand AAA risk, right? So you've got the New Zealand government's AAA, the LGFA's AAA, and then this water entity could be AAA, depending on how they structure it. But if I'm an investor, the LGFA pays a higher interest margin than the government. So let's say it's 20 or 30 basis points, just as a number. So that means that if you're an investor, you go, oh, okay, well, I've only got a certain pool of New Zealand exposure. Shall I buy the government at 4%, or shall I buy the LGFA at 4.3%? Or shall I expose myself to this water entity at 4.5%? So what you could get is that investors will drift towards LGFA and water, and then the government will have to pay higher. So New Zealand Inc. will end up paying more. So that's the issue I think we face, is that we could actually have this dilution of the AAA exposure, and New Zealand Inc. will end up paying more for its borrowings. It would be much better if the government just funded Three Waters directly through some sort of mechanism, and just left LGFA it was. So I think there is a risk that council and New Zealand government funding costs could increase slightly because of this structure. So I don't think liquidity is an issue. I don't think the ability to get money off of the issue, but there is a risk that margins could increase a little bit over time.
Okay. Yep. No, thanks for that. Hey, my second question is, and yeah, some of the councillors around the room obviously have been here for varying lengths of time. But look, yeah, I mean, Earl, you'll well know that winding it back 3 or 4 years, 3, 4, 5, 6 years. Yeah, we made we entered a number of arbitrage deals. So yeah, so for the councillors who aren't familiar with that, what we did is we had plenty of borrowing headroom. So we were able to actually borrow, taking advantage of the very cheap borrowing that was available to us, the cheap margins, etc. We were able to, I guess, do what a bank does in terms of borrowing cheaply, and then putting that money into term deposits on a matched terms basis, and creating an arbitrage profit margin. Earl, we did that probably for 4 or 5 years, and made over $1 million just from those arbitrage margins. Obviously, the way that interest rates played out over the last 2 or 3 years, that opportunity was essentially lost. But yeah, do you see that there's any chance that we might be able to get back into that game, for want of a better word? Yeah, like we did it pretty conservatively, obviously, with those match terms, etc. But will some of those opportunities open up again, do you think, with interest rates obviously being a lot higher now than they were for that period?
Yeah, I think, and I think it's there's not often you get a free lunch in financial markets, and because of the distortions in term deposit rates, where the banks get rewarded by the central bank to have sticky term deposits, so they tend to pay up on term deposits, and then you get your ability to fund through the LGFA. You can actually have a free lunch, and that's it's not a speculative. It was a free lunch, so that was, and it was great to see those those hundreds of thousands of dollars flow into the council. That's for sure. Now those opportunities may come again, and I think 2 ways. As the curve change and things happen, you may see those short-term LGFA rates drop to a margin below term deposits, which will remain sticky because we expect the cash rate to stay high. So there may be some opportunities. But the second thing would be, let's say you've got a project that we want to that's going to start in a couple of years' time, and we're going to fund that for probably borrow for 5 or 10 years, and let's say the 10-year borrowing rate's 4%, whereas the cash rate's still at 5.5%. So we could borrow that, pre-fund that expenditure, and then say put it in a TD for 2 years at 6% and make a nice margin. So what we're effectively doing, there's 2 ways of doing it: just pure arbitrage, where you borrow off the LGFA and place the funds in a TD for exactly the same term and make some money and make a margin, which offsets some of your, so all we're really doing is decreasing your interest expense, which is good. And the second one is pre-funding, projected CapEx. And we can do that pre-funding because we can actually place the funds until we need them at a higher interest rate than what we're paying. And those kind of things, we can work through with you on a case-by-case basis, Ken. But I think there may be some opportunities over the next year or two to actually decrease your interest expense with some of those opportunities again.
Okay. Yep. Cool. Thanks, Landon.
Okay. Any other questions? Nope. Okay. I think, hey, Earl, thank you very, very much. Really a real pleasure to have you come and speak with us, even though we can't see you. We've been able to engage quite well anyway. So appreciate your time on this and your thoughts. And we'll say goodbye.
Yeah, my pleasure. Anytime. And next time, I'll make sure I come down live, because it's always good to engage and meet with you guys and hear about what's happening on the coalface, because it's interesting times out there, and your ratepayers are under pressure, and we're all under pressure, and it's going to be an interesting year or so, I think. And this election is going to cause a bit more volatility, so we'll see what happens. but lots of uncertainty, which is good for us, I suppose, the advisors. And on that happy
There you
note, I'll
go.
leave you all. Have a good day.
Okay, Earl, thank you. Bye for now.
Cheers,
Bye.
Earl.
See you guys.
Okay, everybody, let's just have a 1 minute stretch and then we'll ask David to come and talk to us about our population projections. Try this chair out. This one feels better.
Kia ora all, morning, afternoon rather, beg your pardon, it's been a long day.
Good, oh, good. It's been a long day.
Have you all got a copy of the presentation? Because I believe we're going to do this
We do.
manually.
We do. We have it
Yeah.
on our diligence, so we're all ready to roll.
Cool. No, and I'm not going to be as speedy as Brad Olson. That's phenomenal. He didn't even pause. But I will try and get through this quickly. First thing to say is this is a recap of something most of you have seen who were here last year. But there are some new faces, Del Marie and Mike Montgomery, who this will be new to. So I'm going to put the onus on you to ask the questions, and no questions dumb. This stuff is confusing to me even at times. So yeah. Anyway, the reason why we're here, why we're talking about this, is another key piece of strategic information for the LTP. So that's the kind of key issue at hand here. So just in terms of what we're covering, now I've lost my first page, which, dear. Oh, here we go. Got it back to front. Okay, so firstly, I'll talk a bit about background, why it's important. Then I'll go over the process quickly, where we're at, and then next steps. Why it's important, it provides us with key evidence for our strategic planning. Really, really important to know something about what we anticipate the future looking like in terms of our communities, who we're planning for, rather than looking at who's around the table today, because tomorrow is going to be a bit different. So that's why we're doing it. And it's key evidence for two key things that Council is doing right now. One is our next LTP, the to 34 LTP, and the other is Ahuaki, our spatial plan. The other thing that it plays into at a higher level is future-proof. We're a partner in future-proof, and it also helps inform updating the future-proof strategy. And then in terms of who do we rely on to provide the information, we rely on the University of Waikato, and they have an institute there that was called the National Institute for Demography and Economic Analysis, and has now just been renamed TINIRA, Institute for Population Research. But the information we have will have the NIDIA as the reference, because that is now a bit dated, it's 2021, and it's based on the 2018 census information. So it's also a little bit dated right now. You'll all be aware we've had a census this year, but one of the issues we have in New Zealand is it takes quite a while to turn that census information into information we can use. The last census, there were issues getting that out, and hopefully this next one will go quicker. Anyway, what we do is our projections done by the university are updated every time we have a census, or if there's a long break in censuses, we may ask them to do an update based on information they have. And then how they do their projections. There's a picture on slide 5, and the takeaways there are a couple of inputs that demographers can quite easily model. One is fertility. So we have a trend in New Zealand that is of declining fertility over time. So generally people are having fewer and fewer children, and it's a worldwide trend. It's not unique to New Zealand. There are variations between ethnicities in terms of how that plays out, but overall it's a declining fertility. And then the other key influencer is mortality. That's the kind of the rates at which we die, or the life expectancy we have. And that's made significant gains over this last century, but is kind of starting to plateau. So the gains are getting smaller and smaller in that regard. So those two things are quite easy to project, but the difficult one is migration. And if we didn't have migration, New Zealand wouldn't have a growing population. That is the kind of underlying message to just bear in mind. Looking at our future, we're very much determined by our immigration into New Zealand and our immigration from New Zealand. So the inflow and outflow of people. And that plays out both nationally and regionally and inter-district. Typically, Waipa has been gaining people over time, both regionally and internationally. But it is a volatile situation, and it changes over time. And that's the one your demographers really struggle to get their heads around. Then in terms of where we are right now, back in 2021, we had our projections produced, and what we found is something that Councillor Roger Gordon's not here, but I remember him saying at the time they're wrong. The previous projections were wrong, that there were more people in the district than the projections said there were. Well, when we got the projections updated in 21, that in fact was the case. I think there was an undercount in Waipa of about 2,000 people. So projections, as I haven't told you yet, one truism about projections, they're always wrong. So you can also keep that as a treasure. And we've always tended to historically take a medium projection as our kind of guide, because a medium gives you a cone of likelihood kind of in the middle area, in terms of actual growth tends to fluctuate. It goes up and down like a wave. And at any point in time, it's quite difficult to say where things are going to be beyond the immediate future. So medium tends to give you a good kind of middle of the road idea of the future. But what we had pre-COVID is from about 2016, we had a big spike in immigration, and our last projections were done in 2016. They did not see that coming. So we were following a median projection, and what we actually got was even above a high projection in terms of an outcome. So 2021, we all decided, the future-proof councils, to go for the high scenario, which might on the face it sound a bit weird, because that might sound quite risky, because now you're saying, well, we're aiming at a high level. And if migration ceases, as it did over COVID, you kind of can look silly quite quickly, in terms of what's playing out around us. But in actual fact, Waipa's been fortunate during COVID, even though international migration ceased, the tap got turned off, is we still continue to receive people as a district. So Stats NZ, who do the census, they also release every year in June an estimated population. And the ones for since the census, 2019, 2020, 21, 22, have all indicated continued quite good growth in Waipa. So our long-term high growth scenario projection is actually pretty on the mark still. So that's good news. Moving on. And then what's really important as a council is, so we get this information from Waikato, from the university, and it's given to us at what we call a place base. So they give it for Waipa as a whole, but they also give it for what are called SA2, Statistical Area 2. And they are, if you look at these two slides, they're the kind of breakup of Waipa into a bunch of smaller areas. So those are the SA2 areas, the white map. And if you look at that, you can kind of work out, well, I can see kind of where Cambridge is, and I can see where Tiamutu is, and I can even see Pirongia, but I can't see pretty much anything else. And they don't really align particularly well to our urban growth areas, particularly. So they don't give us a lot of detail. They're quite aggregate areas. So what we've done in-house as staff is taken those SA2 areas and broken them down to an SA1 level so that we get a better picture of what's going on the ground. And that's quite a difficult, complicated process. And you'll see that slide there. There's an attempt to show you kind of the Excel spreadsheet that we produced to do that. And remember what I said about projections always wrong. So this is a classic case in point where you're taking a total at an SA2 level and you're devolving it down to a smaller area. And it might sound, oh yeah, that kind of makes sense. But when you do it, you find it's not that easy in actual fact, because the SA2 area might straddle a bit of rural and a bit of urban. Now you've got to allocate. And so how are you going to do the allocation? So you say, well, more people are going to go urban than rural. Well, how do you explain that as an assumption? So you've got to keep spelling out your assumptions. Most growth will go here. Why will it go there? Then you've got to do things like say, what is the percentage of your total of the area? That gives you a kind of a formula for doing that. Then you've got to say how that growth happens over time and allocate it like that. Because the NIDIA things are only done every 10 years. So you've got to do the allocation for the individual years. Anyway, we've done it. So, and we've kind of done a cross-check and we're kind of happy with it, but it's just to bear in mind that's, it is not something that we're trying to say, this is the truth, it's an estimation. Then the other thing just to bear in mind is what does it look like at a place-based? And that just gives you an idea of like how we anticipate Cambridge growing, Tiamutu, and I think the other truism about us is don't forget we're a rural district. We talk a lot about our towns and growth, but a third of our people live rurally. And that ain't going to change. And then the things that you really need to see on PowerPoint, so I'm sorry you can't see this, is the top one was to just illustrate how aging's playing out over time. And what I had there is Infometrics do some really cool stuff now on their website. And if you have got access to it, you can see this. So if you look back to 97, the earliest year they've got information for, our profile, if any of you have done anything in population, you'll know that if you're looking at a population that's growing rapidly, it's a broad pyramid with a broad base because you're getting lots of kids in proportion to your older population. An aging population tends to be more like that, more like a column. And what's happening with WIPA is it's changed from a pyramid in 1997 to that there's a bulge going up with that aging population moving up. So that's, sorry, I can't show you that. That's pretty cool to see because seeing is believing. And then the other thing that bottom image is what are we going to look like in 2050 in terms of ethnic diversity? We're currently kind of one of the more Pakeha white districts in the Waikato, and that is projected to change significantly. And it's not, our Māori population is more youthful, so they are a growing cohort of our total population. So they will grow as a percentage. And then the other interesting thing is our immigrants are changing in terms of who we're getting into New Zealand. They're not coming from Western Europe so much as from Asia now. And so that's the other big change that we're anticipating. The other thing, just WIPA, this was subnational population information that I got off Stats NZ. I've since found WIPA. They've got a projection for WIPA. WIPA is not as dramatic as this. So I will get that out to you. But I will also say that is another projection, and projections are just projections, they're not predictions. And we will update after the next census, but that's kind of where we're at right now. Any questions?
All right, questions.
Thanks. Through the chair. David, just any idea when the census data, you said it takes a while, but you must have an idea of when we might get this?
Hopefully we get some information out early in the new year. Yeah. Yeah.
Thank you, David. Well represented. Just one interesting factor. Do you think that the continuation of the Asian migration, or perhaps seen actually what I'd call Eastern European, the Ukraine war and what's happening and the problems there, do you think that will probably impact on the amount of immigration coming from that area to our sort of countries to get away from that?
That's a really good question. And this goes to, so when Stats NZ do the projections, it's based on what they know at the time. That was pre kind of Ukraine war. And the very thing Brad's relayed to you and Earl is the uncertainty of going forward. A lot of what we say today and we get hung up about is not even what we're dealing with in the future. I mean, some things are more likely than others. Climate change ain't going away. Aging is not going away. More diversity is not going away. But where people are going to be coming from exactly, yeah, you might be dead right in that might well change. But all things being equal right now, if we're looking at where's growing and so on, our sources tend to be it's probably shifting more from Southeast Asia to India, to be honest, right now. But whether that continues, I think the other unknown, this is just speculative from my side, is the continent that's growing the most last is Africa, and we may even see more migrants from Africa in the future. As was mentioned by Brad, I think that shortage of labor, ain't going away. Thank you.
Tēnā koe, David. Tēnei te mihi atu ki tō kōrero I tēnei rā. I'm resonating a little bit of hearing Frances Valentine's presentation she gave at the LGNZ last week, and her stats, of course, reached into about 30, 40 years into the future. And I realise where our stats sit with today. She actually gave me a fright last week because she said that we should be expecting 126 million migrants coming at some stage to New Zealand because of climate boiling, and how attractive it is in Aotearoa, and a lot of Northern Hemisphere migrants are looking to come down to us. You know, that gave me the trots actually, because I thought, shucks, we're just managing to deal with 5 million as opposed to 124. But what she did also acknowledge, and something that I've always taken with me from being in Mason Jury's office, is he projected a heck of a lot of statistics with the Māori growth expected. And one thing that I picked up from Francis's talk last week was how Māori and Pacifica women don't adjust their birthing rates, and how integral our birthing rates will be integral to the workforce in the future, because unlike Japan and China that had these one-child policies, and then Japan, who wouldn't open up their doors to migrants, are suffering with a workforce shortage now. So it's really interesting to listen to the stats and how you brought them, because I could see the correlation between, even though you weren't talking 126 million people, but I could see the correlation between the statistics. So I am really interested in this, particularly knowing that Māori and Pacifica continue to support infrastructure, I want to say, around how we do things in our country. So thank you for your kōrero. I will have more questions, but probably in a couple more meetings, when I get my head around some of this stuff. Because as I've explained today, I feel like the animal that's stuck outside the car window driving at 100 Ks at the moment. And information is just
Too much.
Thank you.
Kia ora.
Okay, any other questions for David Monty?
This might be one that everyone else knows apart from me and Dale. That you said the NIDIA projections are only done every 10 years, did I hear you say?
The projections, yeah. So they bench it at every 10 year.
And then calibrated off the census or what?
Yeah.
Okay. So the ones we're currently on are how old?
2021, but based on the 2018 census.
Right.
So things date really, really quickly. I mean, there was no COVID then. Futureproof got NIDIA to do an update of the projections with taking into account COVID. And to be honest, it hasn't made a significant difference at a wiper level.
So as you go through that 10 years, do you sort of get further and further from?
Yes, yeah. And I mean, that's why projections give you a kind of a rough direction of where you're going, but they don't tell you an awful lot about the detail. They just help us set a direction. Like we know we need to plan for growth, and we know that there's a significant growth continuing into the future. So those are the things we kind of work around. We know we're aging. We know we've got growing diversity. So we need to cater for more interests, not just what we see around the table. Yeah. Thank you.
All right.
Oh, one other thing, one last thing. So with aging, we thought we would lose our youth, but the migrants bring children. So hence, Ministry for Education said, well, we don't need schools because you're aging. We need retirement village. But you'll know what happened. Yeah, so school rolls kept growing. So yeah, that's the other side of it. Thank you.
All right. Hey, look, thanks, David. If there's no other questions, one more from you.
Thank you, David. I just wanted to ask one question that I'd like to see the figures for the influence of population for that graphic you've given us in New Zealand. I'd like to see it in Waipa centric if we could. That's really positive.
Yeah,
And also that graph, which was a New Zealand graph for the population and diversity in our local area. Because I think that would make it a lot more easy to relate to our own district. You know, because I see that huge deficiency of people where at the age of 20 to 24 years, we seem to lose a lot of our population. That's nationally. I'd like to see what that is actually going through in Waipa as well. Thank you.
good question.
All right, okay, I think that wraps up this for today for some of us. Don't forget for the users that are on the Aki Project Control Group, we are going to be starting at 2:45 and we'll be in the Naroto room. So we'll have a wee bit of a break. Otherwise, thanks everyone for your attendance today. It's been a long day, but it's been a good day.